welcome to the fourth episode of Metis Capital. During this webinar, we will try to explain how we see markets currently and what's next. My name is Jacob Grapengiesser, and here with my colleague David Nicholls. Today is Wednesday, 25th of June, and we'll give you the latest on markets. So David, what are we seeing currently?
Yeah, sure. So if we look at Q2 performance, I think it was a really decent quarter for emerging markets in particular. If we look at this slide, you can see emerging markets up to the 24th of June, returning 5%. And that's above developed markets, which returned about 3%, both in US dollars. And really, if you look at the quarter, there's two sort of really strong narratives. I think the first one was a resurgent China, MSC China, which is the offshore, up 9%. And then a rampant Taiwan, which just continues to perform on sort of this AI sort of structural story. Taiwan returning 12% in the quarter. If we look at year-to-date numbers, I think it will also be remiss not to mention India, which is the other sort of really big market in emerging markets, up 9%. So no, yeah, but a good quarter, good year for emerging markets. And I think the other interesting thing to note is that it's achieved despite sort of pretty notable FX weakness, as you can see if you look at the two right-hand columns of this chart. But yeah, clearly, I think one of the main focuses was China, where Jacob, you're based, and talk about this sort of technical bull market and things. Can you start by putting China's performance in a bit of perspective?
Yeah, that's a good question, David. So China is either doing quite well or really bad, depending on the time frame. For the past 2 months, it's up more than 20%, pretty good. But if you take a 1-year view, it's down 20%. And if you take a 3-year view, it's down actually even 50%. So what does this mean? Well, to us, it means opportunities. This chart might be a little bit difficult to read, but if you look on a company like China Education, it's the largest listed operator of private universities in China. Effectively, you don't get into the very prestigious state universities. You go for the second best. You pay yourself $3,000 per year, which is we think a reasonable amount to pay on a yearly basis. And education companies all around the world are typically trading at quite high multiples because it's a stable, non-cyclical business. There is steady growth every year. And China Education used to trade, as you can see on the blue line here, only 3-4 years back. This was trading between 20 times earnings. And the company was paying a modest 2% dividend yield. Now it is trading at P5, and growth is pretty much the same as it was 3-4 years ago, but it's trading at a quarter of the valuation. And the dividend yield has moved up to 9%. So these are the kind of opportunities we're seeing in China today. But you need to be very, very selective. We have changed a big part of our portfolio in China to find names like this. Another example is a kind of consumer finance company called Lexin or Laoxing in Chinese. This was trading at sort of 5-10 times earnings. It was never a very expensive company. Consumer finance companies typically aren't. Then they actually had some problems, so stock price fell. Then they got their act together. So again, valuation came up to sort of 10-15 times earnings. And now the company is trading at 1.5 times earnings. So yes, we aren't saying that there are no problems in China, but I think valuations are certainly reflecting that and probably provides pretty good opportunities. So what's next then for China? Well, usually the Chinese markets performs in relatively long cycles. And we just looked at, what happens after the first 20%, because rallies kind of continue, right? The trend is your friend, as you say in finance. And now the Chinese market is up 22% since the bottom. And if we take previous rallies, the average was 60%, which means that we have another 30-40% to go, right? And they also lasted typically for 6 months. So, looking at history, probably the market should continue to go up. I'm personally not sure it's going to be a straight line. I don't think anything is a straight line these days, but looking at the valuations and taking let's say a 1-2 year view, I feel quite comfortable. Another aspect that has changed in China are the buybacks. So in the past, Chinese companies, they were all focused on growth. I think they maybe didn't pay enough attention to shareholders, to be very honest. But we've seen the attitude really changing, not for all Chinese companies, but for select companies, they have started to aggressively return money to shareholders. So aggressively doing buybacks, canceling those shares, paying large cash dividends, etc. And this chart is also maybe a bit difficult to read, but this is just showing the planned buybacks for the past 6 years. And as you can see, it's like, give or take, it's sort of the same amount of shares being bought back every year. But this year, which is the black line, is different. This year, Chinese companies have planned 5 times more buybacks in dollar terms compared to the average of previous years. So again, this is a very positive trend. It's not for all companies, but obviously, we know which companies are doing this, and we are positioned in them. I can just mention one company listed in the US. They will buy back close to 40% of the free float over the next 3 years. That's huge, right? I think it's hard to see that if a company is trading at PE5 and they buy back 40% of the free float, that the stock wouldn't perform. Of course it's going to perform. It's just a question of sort of when during these 3 years it's going to perform. But for China, the key question is really all about the real estate sector. Personally, to be very honest, I've been very negative on the Chinese real estate sector for the past 3 years. Every year, you just see that this sector is going down. There are less new starts, as they say, 30-40% less projects compared to the year before. And then the year before was also down 30-40%, right? I was traveling around in China, and you see all of these non-finished construction sites, just cranes just standing. But at some point, this might turn. And we saw a couple of weeks ago the announcement of a 500 billion renminbi support effectively. So the government would inject $70 billion through state-owned enterprises to buy out part of the inventory in the real estate sector. This only corresponds to some 10-12% of the total amount of unsold flats. Obviously, they won't solve it, but I think this might be the beginning of the end of oversupply. And if the government is successful and it does take out the oversupply, this will be the turning point for the economy, also for the consumer confidence, because if you own a flat and the house prices kind of keep on going down, obviously you don't really feel like consuming anything. So it's psychologically very, very important for the Chinese economy. We have shown here a number of different initiatives. It's in terms of their demand side policies. I think the biggest one is this announcement by the government to just physically buy out part of the inventory. But there are also a lot of other, let's say, smaller but still quite important things pushing demand. And then on the credit side, they're also cutting the interest rate. So it just becomes cheaper to get a mortgage loan and to basically finance your apartments. So we'll see. This is, I was in Hong Kong last week, so this is clearly what everyone is talking about. And if we see some more positive news here, that maybe 2025 will be the year that you stabilize the market for Chinese real estate, clearly that would be a huge trigger for the market and the economy. All right, but it's not all about China. David, what else is interesting?
No, it's not. Well, I think, as I mentioned, one of the really big focuses has been on Taiwan, and particularly TSMC, which is the largest company in emerging markets and also the largest company in our emerging markets portfolio. It's up 50% year to date in US dollars, adding around 250 billion in market cap. And of course, a lot of people are asking now if this can become the first 1 trillion US dollar emerging market stock, which definitely feels possible. And just as a reminder, this is by far the largest chip producer in the world. It makes all of NVIDIA's most sophisticated AI chips. And I think in the quarter, one of the really sort of exciting triggers, they announced quite material price hikes for their advanced chips and also some of their more sort of sophisticated chip packaging solutions. And more interestingly, actually, is that the NVIDIA CEO, Jensen Huang, actually endorsed these. He said the price hikes seem reasonable. And actually from our point of view, we see that these price hikes aren't fully baked into sort of consensus numbers. We expect earnings growth of around 25% next year. Consensus is expecting sort of 21, 22%. And as a result, we see this stock as incredibly reasonably valued at sort of 10 times EBITDA for next year. And so, yeah, we still really like it. But I think when we're talking to clients, one point we're always trying to highlight is the sort of EM tech exposure is not just the chip manufacturers, so TSMC, Hynix, or Samsung, but it's actually much more of the sort of this idea of the picks and shovels of the AI. And probably one of the best sort of themes that we've been playing over the last few months is the transformer sector. And actually, it's interesting, Elon Musk said in a podcast a month or so ago that transformers are currently the biggest bottleneck to AI. When you're creating these sort of AI data centers, you need an enormous amount of power, which needs an enormous amount of transformers. And there's a really tight bottleneck in the supply and demand. So we've been investing into some of the largest transformer exporters in emerging markets, names like Hyundai Electric, Fortune Electric, they're in Taiwan, Korea and Taiwan respectively. And these names have significantly outperformed NVIDIA if you look year to date. So I think this is the kind of way that we try to play this AI theme outside of the sort of the very obvious names. But yeah, Jacob, what else has sort of stood out to you in H1 in terms of exciting countries?
Yeah, Turkey is a country where we've been investing for 20 years, and it's always been quite a difficult country. Always macroeconomic worries, I would say, but it's actually up 29% in dollars year to date. Pretty amazing. And the reason is really that you have Mehmet Şimşek as the Minister of Finance, and he's seen as the brain behind the sort of new economic policy of Turkey. And the new economic policies is simply going back to the school book. It's simply about being orthodox in how to handle a crisis situation. So you push up the interest rates. It's currently 50% in Turkey, and then you stabilize inflation. And as you can see here on the chart, it's a bit difficult to read, but you had very high inflation running at 70-80%, and these high interest rates, they sterilize liquidity, as they say. So the expectations are that inflation will come down very sharply in the second half of this year. We will see, because on July 1st, we are waiting for the minimum wage hike, or rather there might be no hike. And that would be the key factor to watch. If we see no hike next week, then the likelihood of this policy working is relatively high. And this is really why foreign investors, they saw that, the market was trading at 4 times earnings in the beginning of the year. And that's just too cheap to ignore if you assume that Şimşek and the central bank can stabilize the lira and sort of stabilize their economy and start to rebuild reserves. But there are also other markets doing pretty well. Actually, Eastern Europe, which is where East Capital was started, and this was our initial focus, and of course that's close to our hearts. And our funds, the Balkan Fund and the New Europe Fund, are doing really, really well. Actually, the Balkan Fund is up 45% for the past 12 months, and our New Europe Fund is up 45%. So we're quite happy to see that. We're quite happy to see those Central European markets strongly performing. And I met actually some people in Dubai, of all places, earlier in the week, and they pointed out to me that you should really invest into Central Europe. So I thought it was interesting to hear people in Dubai telling me that the place to be is Central Europe. I didn't really expect that, actually. Right. So maybe if we move on to elections, it's been a lot of elections, quite important elections, and with market moving effects, David, right?
Yeah, exactly. And I think definitely the place to start is obviously India, which is the largest democracy in the world, over 1 billion people that went to the voting polls. And there was definitely a lot of noise surrounding the elections. Obviously, Modi didn't get the sort of the large majority I was hoping for. But I think if you really to gauge the impact, you've just got to look at the markets, and it's incredible how much value the Indian stock market has added. So this graph shows how when the Indian stock market and the US dollar has reached sort of various trillion marks, it took 10 years to go from 1 to 2 trillion, 3 or 4 years to go from 2 to 3, 2 years to go to 3 to 4, and then basically 6 months to go from 4 to 5. So really, the market's very much taken the election result in its stride. I don't think it's going to result in any sort of materially worse outlook for India. The structural growth story remains strong, but obviously the key story, and I think what people are overlooking, is the market's very much driven by domestic flows. So really, sort of almost irrational exuberance among the sort of domestic retail investors, and excitement for this. But what it does is that wave of inflows really gives us sort of valuation support that to some extent helps you to justify that the valuations that definitely look quite high. We've seen some of our names up sort of over 100% in this quarter, so we are making sure we're quite careful about how we build our India portfolios. We're not sort of all in on small caps. We're very selective in terms of sort of valuation, growth, earnings visibility, and particularly sort of the reputation of the promoters, the sort of the owners of the companies that we're investing with. But yeah, I think if we go then on to Latin America, obviously it was a pretty horrible quarter and a pretty horrible year. Latin America is now in the bottom 5 markets year to date. If you look at Brazil and Mexico, Mexico had an election where Claudia Sheinbaum, the incoming president, had a surprising supermajority, and people are now quite concerned about rule of law and what her party can do in order to sort of a bit backslide on Supreme Court and things like that. Clearly concerning and definitely something we're following. But I think on the positive side, I met with a Mexican CFO last week. He said that in the last 3 weeks since she was elected, Claudia Sheinbaum has met more companies than the outgoing president had in 5 years of his presidency. So clearly, she is a lot more pro-business. She is keen to sort out these bottlenecks that are sort of really holding back nearshoring, like energy security, education, productivity. So I think the long-term story remains intact, although we'll really have to wait till she actually gets into power in October to see more positive policies. We remain very cautious in terms of how we're positioned, really focusing on high quality, high earnings visibility, strong cash flow and strong balance sheets. And that's been serving us very well over the last year, despite this weakness. But yeah, Jacob, what about frontier markets?
Yeah, so by the way, for India, I can mention that and David's done a great job on India, and we've been the first sort of foreign institutional investor into some of these smaller names, and David's been out on the recycling sites, for in remote places in India, etc. So we've been going kind of pretty deep into the Indian market, which was necessary, which is also why we created pretty good performance from there. So frontier markets and smaller emerging markets have also done very well. I think after COVID, these economies and countries were in slightly more of a shock, perhaps, compared to many other ones. They have simply less resources. It was more difficult for them to stimulate the economy, so it took a while before they sort of got their act together. But they're now growing very nicely again, and the stock markets have started to perform. For example, our frontier market strategy is up 19% in dollars year to date. The index is up 6%, so it's a fantastic outperformance. And the EM index is up 7%. So actually, this year, emerging markets and frontier markets, they're performing more or less in line. But we've been good at picking the right companies and in frontier markets, which is why we've been significantly outperforming. Despite the strong performance, frontier markets are trading at an average PE of only 7, and that's with a, let's say, medium-term growth outlook of earnings growth outlook of around 15%, so a PEG ratio of 0.5, which I guess to most people is very attractive.
Yeah, and just briefly on the sustainability side, in the quarter we published both our Sustainable Investment Report and our GEMS Impact Report, so please have a look at that if you're interested. We spoke at quite a few sort of big conferences, the Greenway in Hong Kong, I spoke at a Beaver Mexico conference in London. But I think probably the most material sort of news flow we saw was this Chinese stock exchange publishing some really quite robust corporate sustainability disclosure requirements, and we do a lot of engagement. We have currently 20 ongoing engagements with 13 Chinese companies, and having these sort of really clear guidelines makes it a lot easier actually to really engage and push these companies to improve on sustainability performance and also disclosure. But yeah, Jacob, what's your outlook going into H2 then?
Yeah, so I wish I had one outlook. I think it's a bit more complicated. I think we need to break it down by country or by region. So there are really four large part of the index, and we are more or less country neutral, right? The way we invest, we focus on the companies and not really on the countries. So for China, I mentioned the real estate sector. If we see any signs of that bottoming out, and that's, we are seeing people start talking about it. We haven't seen it happening, but at least it's talked about. That would be absolutely key. We are well positioned in China in cheap companies that have relatively good governance, buying back shares, etc. And the previous rallies clearly have been very strong. So if the trend is your friend, then the market in China can continue going up. For Taiwan, yeah, I mean it's pretty simple. Our biggest exposure is TSMC, making, I think 40% of the capacity is making NVIDIA chips. It's trading at half the valuation of NVIDIA, so just a cheaper way of getting that exposure. India is the absolute opposite. It's digging very, very deep, avoiding the P80 or 100 companies, finding the ones at P15, 20, but with a similar growth profile. It takes a lot of work, and I'm sure you will find companies in our portfolio that basically none of our peers would have. I was recently in Korea as well. Korea is a bit of a different market. Typically, every time you go, it's a little bit boring. Nothing is happening. People are complaining that the market isn't performing. And now, actually, the market started to perform, at least to some extent. They have a so-called corporate value up program. It's the same as in Japan, that the government is trying to stimulate the stock market. And it's even like a political force, right? Because you have a lot of retail investors that are actually voters. So, if the current government can make the stock market perform, they actually get more votes. It's trading below 1x book. Japan and Taiwan are the best peers, I think, in terms of structure of the market. Taiwan is trading at about 3x book. Japan is at least trading at 1.5x book. So I saw a completely different level of enthusiasm and optimism among both local and international investors in Korea. So I think the Korean market looks pretty good, and companies are very, very cheap. For other parts, it's a bit more complicated. I think sentiment remains poor for Latin America, but it's on the other hand only 7.5% of the benchmark. For the Middle East, yes, I said I was recently in Dubai, and I think the mood was very optimistic a couple of months ago. It's more neutral now, I would say. Stocks have performed. In Saudi Arabia, for example, stocks are very expensive. We are struggling to find anything of value there. So we have actually relocated from Saudi Arabia to UAE, where we see same sort of growth, but at more attractive valuations. But again, overall, it's of course all about China going into Q3. And to conclude, emerging markets growth has actually been significantly revised up. So it's expected to be 22% of earnings growth this year in emerging markets and 16% for next year. That compares to 10% only for the S&P 500 for this year and 15% for next year. At the same time, you have a valuation which is just above half of the S&P. So it's P13 versus P23 for the S&P, and again with 22% earnings growth. That to us is a very attractive combination. Thanks everyone for listening. We'll be back in a quarter from now.